a money game, a labyrinth of risk and reward where fortunes are built and dreams are shattered. J. Paul Getty once said, "The only way to make $1 million is to start with $10 million. But what if that wasn't entirely true? What if the key to unlocking unimaginable wealth wasn't a massive inheritance, but a handful of strategic decisions?" Warren Buffett, the Oracle of Omaha, a man who defied the odds, amassing a multi-billion-dollar fortune through the power of investing. But what were his secrets? What hidden knowledge did he possess that propelled him to such dizzying heights? Tonight we crack the code. We delve into the vault of Buffett's investment strategies and unearth the secrets that could change your life forever. Are you ready to learn the 6 stocks that could potentially make you a billionaire? The answer might surprise you. Welcome everyone to Dollar Grow. The question on everyone's mind, can these 6 stocks truly make you a billionaire? Throughout history, countless individuals have chased the elusive dream of financial freedom, often with little guidance, but tonight, we change that. By the end of this video, you'll have the knowledge to potentially unlock a future of unimaginable wealth. But before we dive in, let's hear from you in the comments below. Type stock is wealth. If you believe the right investments can change your life. Let's see how many future billionaires we have in the house. So, buckle up, because this is one investment opportunity you won't want to miss. We're about to embark on a journey that could rewrite your financial destiny. Let's get started. Today, we're diving into the legendary investing world of Warren Buffett. The Oracle of Omaha has built a fortune by making strategic stock picks. But before we jump into specific companies, let's address something crucial. There's no guaranteed path to becoming a billionaire through stocks. Understanding the basics, stocks and profits. Investing can seem complex, but let's break down the fundamental building blocks. When you buy a stock, you're essentially purchasing a tiny slice of ownership in a company. Imagine a company you admire, like a delicious pizza place known for its innovative recipes. By buying a stock, you're not buying the entire restaurant, but you're acquiring a small piece of it. This ownership comes with the potential for 2 main ways to make money. The capital appreciation. This is the classic buy low, sell high strategy that most people associate with stock investing. The success of the company directly impacts your potential profits. If the company performs well, its stock price typically rises. So let's say you bought shares of that amazing pizza place early on, when they were still a small up-and-coming business. As their reputation grows and their pizza becomes more popular, the demand for their stock increases as well. If you bought those shares at a low price and hold onto them until the price rises significantly, you can sell them at a higher price and pocket the difference. Think of it like buying a slice of pizza when they first opened for a few dollars. Now, years later, with their established reputation, a slice might cost several times what you paid originally. By selling your shares, your ownership stake at the higher price, you've profited from capital appreciation. Dividends. Think of dividends as a company's way of sharing its profits with its shareholders, like you. Imagine your favorite pizza place is doing so well that they decide to distribute a portion of their earnings back to their loyal customers, the ones who helped them grow. The dividends are typically paid out quarterly, providing you with a steady stream of income, almost like a mini pizza reward every few months. This can be a great way to generate passive income from your investments, even if the stock price itself isn't skyrocketing. It's important to remember that dividends are not guaranteed. Companies can choose to retain all their profits for reinvestment in the business, or they can adjust the amount of dividends they pay out based on their financial situation. However, companies with a strong track record of paying consistent dividends are often seen as attractive options for investors seeking a reliable source of income alongside potential capital appreciation. Diversification is key. Don't put all your eggs in one basket. Now, here's a crucial principle Warren Buffett himself emphasizes. Diversification. Don't put all your eggs in one basket. This might seem like a simple piece of advice, but it's incredibly important for managing risk in the stock market. Let's revisit our pizza analogy. Imagine you're absolutely obsessed with that one pizza place and you invest all your money in their stock. What happens if there's a food safety scare or a new competitor opens up across the street with a trendy new pizza crust? Your entire investment could be at risk. Diversification involves spreading your investments across various companies and sectors of the economy. This way, if one company does poorly, its impact on your overall portfolio is minimized by the success of others. It's like having a diverse basket filled with eggs from different farms. If one farm has a bad season, you still have plenty of eggs from other sources to enjoy. The goal is to spread your risk across different industries and business types. Here are some examples of different sectors you might consider for diversification. Technology. Companies involved in hardware, software, and internet services. Healthcare. Pharmaceutical companies, medical device manufacturers, and healthcare providers. Consumer staples. Companies that provide essential goods and services such as food, beverages, and personal care products. In financials. Banks, insurance companies, and investment firms. Industrials. Companies involved in manufacturing, construction, and transportation. And by investing in a variety of sectors, you're less likely to experience significant losses if one sector takes a downturn. Remember, diversification is a core principle for managing risk in the stock market. Investing for the long haul. Patience is your best friend. Investing is a marathon, not a sprint. Unlike the portrayal in movies where people get rich overnight, stock market success is built on patience and a long-term perspective. Warren Buffett is known for his long-term approach. He believes in thorough research, careful selection of companies, and holding on to those investments for the long haul. This doesn't mean you can't ever sell your stocks, but it means avoiding impulsive decisions based on short-term market fluctuations. Imagine you plant a delicious apple tree in your backyard. You wouldn't expect to harvest a basket of juicy apples overnight, would you? It takes time for the tree to mature, grow strong roots, and produce fruit. Similarly, investing in stocks requires time for companies to grow, develop innovative products, and expand their market share. By being patient and staying invested for the long term, you're giving your investments the opportunity to reach their full potential. Here are some additional points to consider when cultivating patience in the stock market. Market volatility. The stock market is inherently volatile. There will be ups and downs, periods of rapid growth followed by corrections. It's important to stay calm and avoid panic selling during downturns. Remember, if you planted your apple tree during a drought, you wouldn't pull it out just because it wasn't growing as quickly as you'd hoped. You'd continue to water it and nurture it, knowing that with time and care, it will eventually bear fruit. Focus on the fundamentals. When faced with market volatility, focus on the underlying fundamentals of the companies you've invested in. Have their core business models changed significantly? Are they still well-positioned for future growth? By understanding the long-term prospects of your investments, you can make informed decisions about whether to hold or sell, even during turbulent times. And compounding. Patience becomes even more rewarding when you factor in the power of compounding. Remember, this is the process where your earnings, dividends, or capital appreciation are reinvested, and those reinvested earnings then start earning their own returns. Over time, this snowball effect can significantly grow your wealth. So being patient and staying invested allows compounding to work its magic and exponentially increase the value of your portfolio. Is by adopting a long-term perspective and staying patient, you can navigate the inevitable market fluctuations and position yourself for success in the stock market. Selecting stocks like Buffett. Beyond the headlines, Warren Buffett's success as an investor isn't based on following hot tips or chasing the latest trends. Instead, he digs deep into the nitty-gritty of a company before making an investment decision. This involves analyzing a company's financial health through a variety of metrics. Here are some key documents Buffett focuses on. Balance sheet. This document provides a snapshot of a company's financial position at a specific point in time. It shows the company's assets, what they own, liabilities, what they owe, and shareholders' equity, the difference between assets and liabilities. By analyzing the balance sheet, you can get a sense of a company's financial stability, its ability to pay off its debts, and whether it has enough resources to invest in future growth. An income statement. This document shows a company's financial performance over a specific period, usually a quarter or a year. It details the company's revenue, expenses, and net income profit. By analyzing the income statement, you can assess a company's profitability, its growth potential, and its efficiency in managing its expenses. Cash flow statement. This document shows how a company generates and uses cash. It breaks down cash flow from operating activities, investing activities, and financing activities. By analyzing the cash flow statement, you can see if a company is generating enough cash to cover its expenses and invest in future growth, or if it's relying on debt to stay afloat. Buffett doesn't just rely on financial statements alone. He also assesses a company's market position and growth potential. Here are some additional factors he considers. Market leadership. Is the company a leader in its industry? Does it have a strong brand name and a loyal customer base? Competitive advantage. What sets the company apart from its competitors? Does it have innovative products or services? Management team. Does the company have a strong and experienced management team with a proven track record of success? Future growth potential. Is the company positioned to grow in the future? Is it operating in a growing industry with favorable market trends? By taking a comprehensive approach that considers both financial health and future prospects, you can select stocks that are well-positioned for long-term success, just like Warren Buffett. Diversification done right. Quality over quantity. While diversification is crucial, it's important not to spread yourself too thin. Buffett focuses on a manageable number of stocks that he understands well. Imagine having a delicious pizza with a variety of toppings, but not so many that it becomes overwhelming and loses its flavor. The goal is to have a well-rounded selection of high-quality companies, not a cluttered portfolio filled with random choices. Here's why focusing on quality over quantity is important. In-depth research. Thoroughly researching a company takes time and effort. By limiting the number of stocks you hold, you can dedicate more time to understanding each company's financial health, market position, and future prospects. This allows you to make informed investment decisions based on a strong foundation of knowledge. Emotional attachment. When you're invested in a large number of companies, it's easy to get caught up in the emotional roller coaster of the market. By having a more focused portfolio, you can stay disciplined and avoid making impulsive decisions based on short-term fluctuations. And monitoring and rebalancing. Regularly monitoring your portfolio and rebalancing it as needed is essential for maintaining diversification. As with a smaller number of holdings, this process becomes more manageable, allowing you to react to market changes and ensure your portfolio remains aligned with your investment goals. Here are some additional tips for selecting the right number of stocks for your portfolio. Experience level. Beginners might be more comfortable starting with a smaller number of stocks, typically around 5 to 10, to build their confidence and knowledge before expanding. As you gain experience, you can gradually increase the number of holdings in your portfolio. Risk tolerance. Investors with a higher risk tolerance might be comfortable with a more diversified portfolio with a larger number of stocks. However, it's still important to ensure you can adequately research and monitor each holding. Investment goals. Your investment goals will also influence the number of stocks you choose. If you're aiming for long-term wealth accumulation, a more focused portfolio with high-quality companies might be suitable. If you're seeking higher potential returns with a greater risk appetite, a more diversified portfolio with a wider range of stocks could be an option. Remember, there's no one-size-fits-all answer to the ideal number of stocks. The key is to find a balance that allows you to effectively research your holdings, manage your portfolio, and achieve your investment goals. Managing your portfolio. Active monitoring is key. Investing isn't a one-time event where you buy stocks and forget about them. Just like maintaining a beautiful garden, you need to actively manage your portfolio to ensure its continued growth. Here are some key aspects of active portfolio management. Regular reviews. Schedule regular reviews of your portfolio, typically quarterly or annually. This involves analyzing the performance of your individual stocks, the overall market conditions, and your own investment goals. By staying informed, you can identify any areas that need adjustments. Company news and market trends. Stay up to date on news and events related to the companies you've invested in. This could involve reading their quarterly earnings reports, following industry news, and keeping an eye on any potential challenges or opportunities they might face. Additionally, staying informed about broader market trends like changes in interest rates or economic policies can help you make informed decisions about your overall portfolio allocation. Knowing when to sell. While Buffett is known for his long-term investing approach, there are situations where selling a stock might be necessary. This could be because the company's fundamentals have deteriorated significantly, its competitive advantage has eroded, or your own investment goals have changed. By actively monitoring your portfolio and being willing to adapt when needed, you can minimize your losses and maximize your returns. Here are some additional tips for active portfolio management. Set stop-loss orders. A stop-loss order is a type of order that automatically sells a stock if its price falls below a certain level. This can help you limit your potential losses if a stock takes a sudden downturn. Reinvesting profits. As discussed earlier, reinvesting your profits is a powerful way to grow your wealth over time. Consider reinvesting your dividends or capital gains back into your portfolio to take advantage of compounding. Tax considerations. When selling stocks, be mindful of the potential tax implications. Capital gains taxes are applied to profits earned from the sale of stocks, and the tax rate can vary depending on how long you held the stock before selling. Consulting with a financial advisor can help you navigate the tax considerations associated with your investment decisions. By actively managing your portfolio, you take control of your investments and position yourself for long-term success in the stock market. And the power of compounding. Grow wealth exponentially. One of the most powerful tools in an investor's arsenal is compounding. Imagine you plant a small seed in the ground. At first, the growth might seem slow, but with consistent watering, sunlight, and care, that seed gradually transforms into a mighty tree. Compounding works in a similar way for your investments. Let's revisit the concept with a real-world example. Say you invest $1,000 at a 10% annual interest rate. In the first year, you'll earn $100 in interest, bringing your total to $1,100. Now, here's the magic of compounding. In the second year, you don't just earn interest on the original $1,000. You earn interest on the entire $1,100. So your second year's interest would be $110, bringing your total to $1,210. This cycle continues year after year, with your earnings snowballing due to the power of compounding. The longer your money stays invested and continues to earn interest on previous gains, the faster your wealth grows. Here's why compounding is particularly beneficial for young investors. Time advantage. The earlier you start investing, the more time your money has to benefit from compounding. Even small initial investments can grow significantly over decades. Imagine planting that seed when you're young. It has a much longer time to mature into a large, wealth-generating tree compared to planting it later in life. Long-term focus. Compounding thrives on a long-term perspective. By staying invested for the long haul and resisting the urge to withdraw your money for short-term needs, you allow compounding to work its magic and exponentially increase your wealth. Here are some additional tips to maximize the power of compounding in your investments. Start early. Don't wait until you have a large sum of money to start investing. Even small, regular contributions can add up significantly over time thanks to compounding. Invest consistently. Make a habit of investing a set amount of money regularly, regardless of market conditions. This approach, known as dollar cost averaging, helps you buy more shares when prices are low and fewer shares when prices are high, averaging out your cost per share over time. Reinvest your earnings. As discussed earlier, reinvesting your dividends and capital gains allows your money to benefit from compounding even further. By understanding and utilizing the power of compounding, you can turn even small initial investments into significant wealth over the long term. Why specific stock picks can be misleading. But throughout this video, we've explored Warren Buffett's investment philosophy and the principles that have contributed to his success. However, it's crucial to understand why focusing solely on the specific stocks he owns might not be the best strategy for you. Here's why chasing Buffett's picks can be misleading. Market conditions change drastically. The investment landscape is constantly evolving. Companies that were thriving when Buffett invested in them might not be the best fit for today's economic climate. Imagine a company Buffett invested in heavily years ago was a pioneer in the typewriter industry. While it might have been a great investment back then, the rise of personal computers drastically changed the market. This company, once a leader, might not be a suitable investment choice today. Focus on underlying principles, not specific stocks. The true value lies in learning from Buffett's core investment principles, such as thorough research, a long-term perspective, and diversification. These principles are timeless and can be applied to any investment strategy, regardless of the specific companies involved. Imagine learning the art of pizza making from a master chef. You wouldn't just memorize the specific ingredients they use in their award-winning pizza, you'd learn the fundamentals of dough preparation, sauce creation, and proper baking techniques. These principles would allow you to experiment with different ingredients and create your own delicious variations. Similarly, by understanding Buffett's investment principles, you can develop your own investment strategy tailored to your financial goals and risk tolerance. Don't do your own research. Every investor's situation is unique. What works for Warren Buffett might not be suitable for your circumstances. Before making any investment decisions, take time to understand your own financial goals and risk tolerance. Imagine you're a vegetarian, and Buffett's favorite pizza has pepperoni as its main topping. While you admire his success, that specific pizza wouldn't be a good fit for you. Similarly, by understanding your own investment preferences and conducting thorough research on individual companies, you can identify stocks that align with your investment goals and risk tolerance. They focus on building a strong investment foundation. And before diving headfirst into the world of stock selection, ensure you have a solid financial foundation in place. Here are some crucial steps to take before actively investing. Build an emergency fund. Life throws unexpected curveballs. Having an emergency fund with 3 to 6 months of living expenses can help you weather unexpected financial emergencies like car repairs or medical bills without needing to tap into your investment portfolio. Imagine your investment portfolio is like a delicious pizza you've carefully crafted. An emergency fund is like having a safety net. It protects your pizza from financial mishaps that might force you to sell it prematurely. Pay down high-interest debt. High-interest debt, like credit card debt, can significantly eat away at your potential returns. Prioritize paying off these debts before investing, as the interest savings will likely outweigh any potential gains from the stock market, especially in the short term. Imagine your investment portfolio is a delicious pizza fresh out of the oven. High-interest debt is like a constantly dripping faucet. It continuously drains your resources and prevents you from fully enjoying the fruits of your investment labor. Invest regularly. The power of compounding thrives on time invested. Even small, regular contributions can add up significantly over the long term. Consider setting up an automatic investment plan to consistently invest a set amount of money, regardless of market conditions. Imagine your investment portfolio as a garden. Regularly planting seeds, investing allows them to grow and flourish over time. The earlier you start planting, the more extensive and bountiful your investment garden will become. Cultivate patience and discipline. Investing is a journey, not a destination. There will be ups and downs, periods of rapid growth followed by corrections. It's essential to cultivate patience and discipline to navigate these market fluctuations successfully. Patience for long-term growth. The stock market doesn't always move in a straight line. Don't expect to get rich overnight. Focus on building long-term wealth by investing in quality companies and holding onto them for the haul. Imagine your investment portfolio as a delicious pizza dough. It takes time for the dough to rise and become perfectly cooked. Similarly, achieving significant investment success requires patience and allowing your portfolio time to grow and mature. Discipline to avoid emotional investing. Emotional decisions based on fear or greed can be detrimental to your investment strategy. Stick to your investment plan and avoid panic selling during market downturns. Imagine your investment portfolio as a pizza you've carefully selected. During market corrections, the pizza might seem less appealing due to short-term price fluctuations. However, by remaining disciplined and holding onto your investments, you can still enjoy the full benefits of long-term growth once the market recovers. Discipline to stay informed. Staying informed about the market and the companies you've invested in is crucial. However, avoid information overload or making impulsive decisions based on every news headline. Focus on reliable sources and conduct in-depth research before making any adjustments to your portfolio. Imagine your investment portfolio as a garden. While it's important to be aware of the weather forecast market conditions, you don't need to check it every hour. Overwatering your plants, reacting to every headline, can be detrimental. Instead, stay informed about significant changes and focus on providing your investments with the care and attention they need for long-term growth. Learning from the master. Invest like Buffett, not just in his picks. Think of Warren Buffett as your investment mentor, not a stock tipster. Instead of simply copying his every move, use his principles to develop your own sound investment strategy. Here's how to learn from the master. Read books on value investing. Buffett is a strong proponent of value investing, which focuses on identifying stocks that are trading for less than their intrinsic value. Educate yourself on this approach by reading books written by Buffett himself or other value investing experts. Imagine you want to learn how to make the perfect pizza dough from a master chef. You wouldn't just watch them knead the dough, you'd also read their cookbooks to gain a deeper understanding of the techniques and principles involved. Similarly, reading books on value investing will equip you with the knowledge to analyze companies and identify potential investment opportunities. Learn about financial statements. Understanding financial statements like balance sheets and income statements is essential for evaluating a company's financial health and future prospects. Invest in learning how to read and interpret these documents to make informed investment decisions. Imagine financial statements as the blueprints for your investment decisions. Just like you wouldn't build a house without a blueprint, you shouldn't invest in a company without understanding its financial foundation. And by learning about financial statements, you can assess the stability and growth potential of a company before investing. Stay updated on market trends. The market landscape is constantly evolving. Stay informed about economic trends, technological advancements, and any other factors that might impact your investments. This knowledge can help you adapt your strategy and make informed decisions. Imagine your investment portfolio as a garden that needs to adapt to the changing seasons. By staying updated on market trends, you can adjust your investment strategy as needed to ensure your portfolio continues to thrive in different economic climates. But that was a roller coaster ride of information, wasn't it? We explored the potential of these 6 stocks inspired by Warren Buffett's legendary investment strategies. Remember, these are just possibilities, and the key to success lies in thorough research and a well-defined investment plan. As the wise Baron Rothschild once said, the greatest danger in times of turbulence is not the turbulence, it is the action you take in response to it. Don't rush into decisions based on hype alone. Equip yourself with knowledge, and remember, patience and discipline are your greatest allies in the market. This video is just the beginning of your financial odyssey. We're passionate about empowering you to take control of your future. So smash that subscribe button to join our growing community of financially savvy individuals. And don't forget to check out the video linked in the top right corner, where we delve deeper into the world of money management. We'll explore budgeting strategies, saving techniques, and expert advice to help you navigate the complexities of the financial landscape. By following these steps and learning from Warren Buffett's core principles, you can develop your own investment philosophy and navigate the stock market with greater confidence. Remember, there's no guaranteed path to becoming a billionaire, but with knowledge, discipline, and a bit of patience, you can achieve your financial goals and build a secure future. Remember, knowledge is power, especially when it comes to your money. Let's build a future of financial freedom together. Leave a comment below with your biggest takeaway from this video, and let's keep the conversation going. Until next time, happy investing, and be mindful of the inherent risks involved in the stock market.